Hi, I'm Roger Aguinaldo, and welcome to the M&A Advisor podcast. Since 1998, the M&A Advisor has been the definitive source dedicated to recognizing achievement, delivering unrivaled thought leadership, and connecting the world's mergers and acquisitions elite. We help you sharpen your edge and accelerate your success in deal making. Whether you're an ambitious new player or a market veteran, this podcast provides masterclass strategies, unvarnished stories, and vital lessons from the industry's influential figures. Before we launch into this episode, be sure to follow us on YouTube, Apple Podcasts, and Spotify, and subscribe to our essential M&A Alerts email newsletter. Find all the links below. Your engagement fuels the deal-making community. Now let's get into the transaction.
All right. Well, thank you for joining us today. As mentioned, I lead the U.S. financial news team at S&P Global Market Intelligence, and I've been kind of following the investment banking industry since 2008. And I recently launched a podcast where I talk with investment bankers, and that was the main reason why I launched the podcast was so I can have more conversations. And that's why I'm kind of excited about today's conversation, because I'm certainly sitting down with someone who's on the investment banking front lines right here. Andrew, his firm, Golden Circle Advisors, it serves the lower middle market, companies with revenue up to $100 million and EBITDA up to $10 million. Andrew previously worked for an investment banking firm called Bridgepoint in Omaha, but about a year and a half ago, he made the move to Golden Circle, which is in Traverse City, Michigan. And if you're not familiar with Traverse City, Michigan, it's in an area it's a snow belt region, so it gets like up to 10 feet snow a year. And Andrew has a family. So my first question for you is just curious on why you decided to uproot the family and move to a place where you get 10 feet of snow.
That wasn't part of the advertisement for my wife. So the big move was family related. So we have 3 children. My wife and I lived in Omaha, Nebraska. I loved my prior firm, but I love my wife and I love my kids, and Northern Michigan was the spot for us. Little did I know that it does snow so much, and I'm terrible at shoveling. So get the 5 a.m. call, and my wife's looking at me saying, hey, you need to get that out there and shovel, and I'm very frustrated. Being a banker, not good at snow shoveling. I go, I'm not doing that. And she goes, doesn't say anything, walks out the door with the shovel. And that was about all I needed to know, but moved to Northern Michigan for family reasons. And there was a business brokerage there called Golden Circle, and I love investment banking. The partners there were pretty good, but focused on deals that were lower than 10 million TEV or lower. My partner and I, Charlie Spearing, now we bought out the partners. Charlie is an operating partner that worked for American Securities, but more of the operator side. So I'm on the banker side. My last firm I worked for, great firm, had a good run there, learned how to do deals A to Z, joined up with Charlie, and then we bought out the Golden Circle partners to help evolve it into a lower middle market investment bank, helping companies 1 to 10 of EBITDA with capital raising and sell side services. But the reality is, what was funny, when I made the move from Bridgepoint to Golden Circle, everyone's like, no one's looking at deals sub 5 million of EBITDA. What are you doing down there? What's going on there? The first deal we closed was a 1 million EBITDA millwork manufacturer in the middle of Michigan, town of 400 people. We sold it to US LBM that was backed by Bain. And I was like, oh, the market's here. And we've done private credit deals, so non-dilutive deals and sell-side deals with institutional buyers and institutional credit firms all over the country that are highly interested in this space. So the thesis for us when we made the move was family reasons, really important to me, but scaling a firm that's focused on helping companies that are underserved. So think like sub 7 million EBITDA. Everything we work on is getting institutional attention. And at the time when I made the move, it was a hope. And now it's the reality that everyone's down market. And it was funny, so that millwork manufacturer, we're on all the diligence calls, and it's a brother team, and one of the guys is in the front seat and brother's in the back seat, and buyer had all their diligence guys on the team screen, and here we are representing them, and it was like, to me, that's why we do it every day. It's been a fun ride. I got to figure out how to mitigate the snow, but I don't know if I'll be able to do that. Yeah.
Well, maybe you could negotiate a snowblower into one of your
there you go.
M&A fees. How did you find Golden Circle?
Yeah, so we knew we would eventually eventually make the move to Northern Michigan at some point in our life. The Golden Circle guy, the guy who founded Golden Circle, Curtis Kutnauer, he was a University of Michigan grad in the 80s. That he was a computer science major. And he always tells me I was working on AI in the 80s. And so anytime I would interact with him, he would respond to me in 10 seconds. He was highly responsive, and his customers loved him. And he and I had built up a relationship over time. And I loved Bridgepoint. It was a great firm. I learned a lot. At the time, we thought we would be there long term. But Golden Circle, we kept evolving it. And then once we had our third kid, we needed help. And so we needed to move closer to the grandparents. And Golden Circle was like, why don't you join us, and let's see what we can do. I always wanted to start a firm, but those guys had built a good reputation in the town and had done a handful of deals very well. And so ended up joining on with them.
So how do you go about sort of networking and building relationships with potential clients? Yeah,
so Traverse City is a very small market. It's absolutely beautiful there, but you can't build an investment bank if you're just focused on the Traverse City market. So for us, I've been on airplanes, and our team's been traveling quite a bit this year. Spent about 70 days in hotels. Our deal flow comes from attorneys and financial advisors that are all over the country. And we drive into that. We lean into that. So really developing the right network of advisors on our deals, right? So when we go to hire counsel, it has to be counsel that can stand up against Baker McKenzie. Even if it's a $20 million deal, we do a deal well with them, and then the referral starts to happen. But it's really boots on the ground. We do road shows in, I would say, kind of like, third-tier markets. So for instance, like Pittsburgh, Pennsylvania, we spend a lot of time there. We have a handful of situations in Phoenix, Arizona, and it's us getting on an airplane, going to spend time there, and telling the Golden Circle story. I think what helps is having Charlie as the operating partner that has worked in American securities-backed companies, and the rest of our team. We just hired a gentleman from BMO Capital Markets. We have a good core execution team, and I think when they hear our story and that we're down market, the reality is it's so underserved that we're competing against business brokers. There's nothing wrong with business brokers, but when they hear our actual pitch and we show our materials, before we get engaged, they're like, holy smokes, like, you guys actually know the value drivers of my business. You're going to give me a fighting chance. You know that I don't want to dilute myself, and you gave me an option. It's a whole different pitch. So I think the attorneys and financial advisors we talk to, they're like, you'd work on a $2 million EBITDA deal? Come on in. Like, it's a very low barrier to entry.
Yeah, and on your LinkedIn website, it mentions that you try to serve you're looking to serve underserved clients. So are you just referring to clients that have the low EBITDA or the $1 million?
Yeah, so like sub $5 million EBITDA, I would see that as underserved. Like in the bake-offs that we're going, when we're doing bake-offs, it's against business brokers or people that deem themselves an investment bank, but they have no idea the banks we go against typically don't know how to do capital raising. So like the reality is there's SBIC funds out there that'll do non-dilutive deals, minority equity deals, and when we go pitch a $4 million EBITDA owner that he's not going to dilute himself to get $20 million of capital, they're like, that's underserved in my view, that he doesn't know that exists. He thinks the only way he can find capital is through his senior bank. And then when you run a sales side process and you get into the room on the pitch, and they're like, how in the world did you know that these guys would be a good fit for us? How did you have these conversations before we're even engaged? In my mind, a $3 million EBITDA sourdough bread company we represented, they had no idea that there was a whole universe out there, both domestically and internationally, for their business.
Yeah, and you previously worked for a private equity firm. How has that experience helped you in your current role?
Yeah, so I worked before I joined Bridgepoint. I worked for an independent sponsor that no longer exists, but it was called Calusa Capital Partners. They were in Southwest Florida. I had the opportunity to work with two really smart guys, and what it showed me very quickly was this side of the market, the lower middle market, is underserved from a banker perspective. And then it showed me basically the guys that I worked with were excellent at describing their value as a PE fund, and they got themselves into countless management meetings. And I was like, there's buyers of all types for companies that are sub 5 million EBITDA. And for me, the PE thing was fun. I think right out of school, like it's exciting to be in PE, but I knew very quickly that I wanted to be an advisor so that I could act on behalf of the owners, be the advocate for the owners, because we would put structures in front of owners and they wouldn't understand it. And they didn't have an advisor that was focused on helping them understand it. So for me, the PE experience, it was excellent. but it was very clear to me that I wanted to be on the other side of the table.
Yeah, that's kind of normally the people go from the investment banking side to the private equity side, but you did the opposite.
Yeah, no, I did the opposite, and I'm here to stay. I'm going to be doing deals until as long as I'm alive. I love it. I think the reality is that the owners need the help. The strategics and the PE groups that are coming down market to do these add-ons, it overwhelms the owners. And so there's a big mismatch right now on the lower end of the lower middle market from the buyer sophistication and the advisor sophistication. And I think it's our job as the deal community to help balance that out a bit. Fees are fees. They come and go, but these owners deserve to be treated the right way in these processes, and that means an end-to-end white glove experience. Everyone talks about AI and how we drive that. I do think it's a tool, but these owners deserve attention, even if they're 2 of EBITDA, to make sure they make the right decision for their people and really the community business they built.
Yeah, I'm sure even the private equity institutional investors appreciate what you do because you can kind of bring them deals. Right?
Yeah, I think the PE guys and the strategics and the private credit guys, they appreciate when we're involved because we get quality of earnings on the front end of all of our processes. We bring in the right counsel, and we run we are literally hand-holding that owner through it. If a PE group or a big strategic tries to find a proprietary deal, it's 4 months to just even get the information right. So we see their shoulders come down when we're involved on the other side. Yeah.
Okay. And Golden Circle, you guys work on a range of sectors, right?
Yeah, I'd say we're sector agnostic. I mean, we closed a sourdough bread business. I didn't know anything about the sourdough bread sector before we pitched it. I mean, my wife makes, or tries to make excellent sourdough. There's like a TikTok trend. That's like what I knew about it. But getting into the process, you end up realizing that's the fastest growing segment within bread. And the owners didn't know that. They thought that they had 4 buyers that were all local in the community. And so we did that deal. We have a tech-enabled public adjuster. I mean, when we met those guys, I was like, just step me through like I'm a first grader what public adjusting is. How do you even make that tech-enabled? And so where we're different, though, is when we pitch, we bring the owners options. So that's an agnostic practice. So we show what the math is for a non-dilutive capital raise, a minority equity deal, majority equity sale, and then full sale. You can do that for any sector. And I think the sweet spot for us is it's like a $3 million EBITDA company, $2 million, $1 million of EBITDA we get excited about.
Did you sell the bread company to one of the local buyers?
No. We did not sell it to one of the local buyers. It went to a very large strategic, and there was also a PE fund that was involved as well. So, yeah.
Interesting. Okay. So, but how difficult is that to stay on top of different industries and as opposed to just having a focus in one area?
So it's not difficult at all. How we pitch, when we prepare for a pitch, if we have a 10-day, we usually give ourselves a 10-day run to prepare for a pitch. We've already talked to the top 5 or 10 private credit, private equity, or strategic buyers before we go talk to that owner. So when an owner flips to that page in the book, that's where they spend all the time. My guys and I can put together a nice discounted cash flow that doesn't even make any sense because we've never been running that company, and show them valuation. But where owners spend the most time is where we got the market feedback, and that doesn't take very long for us to get because we have a good network and people know the folks that are on our team and they want to jump on the call with them because, frankly, buyers and private credit, private equity guys, they want to jump on the phone and give good intel, so they're the first one to see the deal, if that makes sense. So, for instance, the sourdough bread company, we had 10 logos and had conversations with all of those groups about the value drivers, where multiples are. I mean, we can show, where things traded before. We can show a discounted cash flow. All those things are well and good. But that constant ear-to-the-ground dialogue, that's what we get people. Because the reality is, the lower end of the lower middle market, it's constantly evolving. And you need to be aware of the trends that are going on from a macro level to give that owner a good point of view. For instance, with all these tariffs, right? Companies look a lot different than they did 2 years ago. If I look at a comp from 2 years ago and say, you're going to trade for 10 times because we have this direct comp from 2 years ago, incorrect. That's not the right answer for the owner. Yeah, it was really easy to pull down by using the different tools we have. We go the extra mile, whether it's a private credit, private equity, or full sale situation, to give that owner real-time insight. And I think that's where they're like, oh, wow, they don't really need industry expertise. I would say we don't have as much friction related to that because we're in the lower end of the lower middle market. Yeah.
So it's more like blocking and tackling and making sure they're you're doing the process correctly.
Yeah, and I think just on the front end of the pitch, like where the light bulb goes off for the owners is like, wow, these guys went the extra mile and had these conversations before they met with us, and that's a 10-day window. So like the bread company, we talked to 3 strategics and 3 PE funds that were in the space that those owners never even knew of, and we had a page talking about the feedback we got. And they were like, compared to the broker that we went up against, it was night and day.
So they're okay with you talking with the other side first, or?
We don't give the name of the company. It's an anonymous discussion. But the point is, we showed enough interest in their deal to give them that feedback, and like that to them is, it does. I mean, from a standpoint of bandwidth, you need to hustle to get those conversations going. We have a great network of people on the other side that we know very well, so it's not hard for us to do that. But it gives the owner a very informed view of where they're at today, from a valuation, will I trade standpoint. And then we show them, the valuation analysis that's all based on what a projection could be 5 years out. How can a $7 million of revenue, $2 million of EBITDA sourdough bread company project where they're going to be in 5 years? I mean, it's not an easy thing to do. So,
right. Especially when you try to factor in the TikTok boom.
Exactly.
So M&A overall, like, at least from my perspective, it's been slower since 2022. But I know it's different in different markets. So, the lower middle market segment, I mean, has it really been affected by the slowdown?
No, there's a lot more velocity. There's a lot of velocity for sub 5 million EBITDA situations because you have PE funds that are pushing down market, and then you have strategics that are a force multiplier on that. And so there's a land grab. Like, for instance, if I go back to that 1 million EBITDA millwork manufacturer that sold the US LBM backed by Bain, 1 million of EBITDA, and we got 9 bids on it in an environment that wasn't great for M&A. In every process we run, as long as the general trend for the sector is there, meaning that there's M&A happening, the buyers are kind of in frenzy mode because it's not a big risk to buy a 2 million EBITDA company if it makes sense for some strategic rationale. And the thing that blew me away since moving down market is how many buyer types are out there. So not only do you have the strategics and the private equity groups that are trying to roll up the space and go, you have entrepreneurs through acquisition, you have independent sponsors, you have all these folks who are targeting this lower end of the lower middle market. And that's been something that was surprising to me, to be honest. I would say, mentors that I have that are up market, they said it's a waste of time to be down there and that it's going to be a career limiting move. I did it purely for family. Like, I was like, this has to work. My partner and I, we bought out Golden Circle because we thought it could happen. What I'm seeing is, regardless of what is going on in the M&A kind of broader, larger deal realm, the lower end, the lower middle market charges on because it's always a way for folks to grow through M&A, especially for the smaller deals.
Mm-hmm. Interesting. And you mentioned tariffs earlier. Any specific sectors or client types that you've been dealing with that are more impacted than others?
The distribution. So companies in distribution, you have to be very, very thoughtful around how you position the quality of earnings, and just to make sure that the owner is eyes wide open on the impact of tariffs. So on the front end of all of our processes, even if it's a 2 million EBITDA company, we're getting a quality of earnings because there's add backs, both negative and positive, that and a quality of earnings is effectively a third party accounting firm coming in and validating what the EBITDA is. But distribution in particular, there's been an interesting, related to tariffs, that's where we've seen it impact the most, distribution and manufacturing deals. But some of these companies are finding ways around it and being creative on how they can navigate it for years ahead. And so we want to make sure we get our owners the most credit for that. And there's a reality that some of the owners are caught in the middle of it right now. Mm-hmm. And we just try to be as forward-looking as we can. So we don't just have the owners run out to the market with their numbers, if that makes sense. We really dig on them and make sure that everybody's eyes wide open on what's going on with the company.
I thought I'd open up to the room. Does anybody have any questions for Andrew? All right. Go ahead.
How's the upper Midwest compared to the rest of the country for deal flow and quality of... How does the upper Midwest compare to the rest of the country for quality of management teams and deal flow?
Yeah, so when you think about like Michigan and kind of that Rust Belt realm, like if you think Michigan to, I say Michigan to Pennsylvania, I've been very impressed. So the management teams are really strong. There's a lot of folks who are like engineering and manufacturing minded. So you're dealing with, in my opinion, I've been really impressed. Even a 2 million EBITDA company, they kind of have, owners that are in their 60s and 65. They get old-fashioned approach, but these guys have a level of sophistication where they have ownership of the community, ownership of really the company they're trying to build. But then it's like the level of quality of the owner to the second layer of management is where I've been most impressed, is they really care about kind of their bench of leadership. And just being in the Rust Belt, I've on the manufacturing and the engineering firms that we've worked with, it's been, I always say it's like they're already PE-backed from the leadership team perspective. They really build out that side of it. So it's been refreshing that way.
Great. Okay. Looks like you're just about out of time here. Does anybody else have any one last question, maybe? All right. So I can ask one more. Interest rates. Just kind of curious on. They've been coming down. Has that been a catalyst for you in some companies?
It's certainly. I mean, so there's definitely a frenzy for the lower end of the lower middle market, but I do see it's a catalyst related to the owner's sentiment around wanting to go to market. Like that's where I see it. There's some comfort around, okay, interest rates are coming down. In their mind, it's like, okay, this might be a good opportunity for me to go. So we've, in the last couple weeks, we've won 3 or 4 engagements all in a row. And I think it's related to the owners having some, interest rates coming down, right? It could be volatility in their mind. But I think the owners are like, wow, if the interest rates come down, they might be able to pay more for my company. That's just and they may not know all the nuances of deal structures that we all know, but in their mind, their shoulders have come down a bit versus where we were at the beginning of the year where everyone was uncertain about tariffs. I think it's the interest rates coming down has opened it up a bit on that side.
Sort of help with the executive confidence there.
Awesome. Thanks, Joe.
Okay, thank you.
We hope today's episode delivered actionable intelligence. We want to hear from the field. Share your questions or insights, leave a message on your favorite platform, or email us at editor@maadvisor.com. To secure your steady feed of premium M&A content, follow us on Spotify, Apple Podcasts, and YouTube, and subscribe to our M&A Alerts email newsletter. Find the links in the description below or visit us directly at our website at www.maadvisor.com. I'm Roger Aguinaldo, founder and CEO of the M&A Advisor. Thank you for being part of the M&A Advisor community. Until next time, stay decisive, stay connected, and happy dealing.